Hello and welcome to our discussion on the preparation of financial statements when a set of business decisions are given. So in this session we will try to understand some important features of the financial statements of power distribution business. The power distribution business, they buy power from the generating companies and sell power to the ultimate consumer. To understand the power distribution business, we will see a set of financial statements and see the effect of the transactions on those financial statements. So in this session we'll see a question where the balance sheet is given, set of transactions are given, and we are required to prepare or understand the effect of the transactions on the financial statements. So unlike many other businesses, in power distribution business, when you purchase the power, you can't store that. So the entire purchase power will become the cost of goods sold and will be shown in the income statement. So let us go to the Excel to understand that. So these are the transactions of a company, A Limited, and the financial balance sheet is showing some set of assets with the corresponding sources. We see the transactions are, they made some issue of shares, they purchased power, paid expenses, sales, and other related expenses. So we'll take one by one and focus attention on the purchase of power as we move along. So issue of shares of 10 at 50 is a receipt, so therefore capital will be 1000 into 10, and you're also collecting share premium of 10 of 1000 into 40, 1000 into 40. So the capital increases from 25 to 35, and a new source will appear on the balance sheet in the form of share premium. The share premium is 40. Now purchase of power, this is, and they paid money for that, so therefore let me write down as a cost of power 20,000, and entire cost will become an expense because entire power has to be sold during this accounting year. Admin expenses paid, so therefore admin expenses is 12,000, and admin expenses is an expense in the income statement, and admin expense 12,000 will appear in the cash flow as well as income statement. If you would not have paid that money, an outstanding expense would have been there on the balance sheet. Now see the entire, and the sales during the year, what did they sell? They sell the power that they purchase. So therefore sales is an income of 50,000, and the corresponding cost of the power is we already recorded as an expense. But we have not received the entire 50,000. The sales that we have received is 90% of this sales, 0.90. So the balance will increase the debtor. So debtor will be 28 plus 50 minus 45. So the debtors on the balance sheet will be 28 plus 50 minus 25 minus 45. Depreciation on transformers. So depreciation is an expense and no cash flow, but the reduction in the value of the transformers. So depreciation is an expense and a reduction of asset. They purchase an R&D maybe for improving some of their operations. So R&D they paid for 20,000, but the life of the R&D is 4 years. So therefore R&D as an expense will be 1/4 of the cost of the asset, that is 20,000 divided by 4, and the balance will be appearing on the balance sheet as an asset. So you can see that. So R&D, money paid acquired is 20,000, expense is 5,000, and asset is 15,000. Asset is unexpired benefit and expense is expired benefit. And that depends on the decision of the management, which they have taken here 5. Now paid off old creditor, you see the old creditor sitting on the balance sheet 8,000. So the creditors are paid off, but it's a payment but not an expense, but is a reduction of liability. So 8,000 minus 8,000, so the creditors reduce. So it's a payment but not an expense, but a reduction of liability. And no other transaction given, but there is a loan sitting on the balance sheet, so therefore interest will appear in the income statement as an expense, 0.12, 0.12, 0.12, and interest, let us assume that it is, though it is not mentioned, entire interest is paid during the period. So total income 50,000, total expenses 52,000, so there is a negative profit of 2,000. If no information is given, we will include that in the reserves instead of showing as a separate item. The cash flow statement will show the total cash available 135, total payment 63, so therefore cash in hand is 72,000, which will be in the balance sheet. So the two items on the balance sheet, that is reserves and cash, are affected by the outcome of the income statement and the cash flow statement. During this period, no change in the long-term liabilities, no change in the outstanding expenses, no change in the tools, and as a result our balance sheet showed so the transformer depreciation minus this. Okay, so the total of assets 231, supported by the corresponding sources of the point which we wanted to understand is the cost of the power. So the entire cost of power, unlike other businesses where stock acquired and stock is shown on the balance sheet, the main material purchase is sold immediately, so the entire purchase is becoming an expense. Now if you see the debt equity ratio of this company, so the debt is a long-term debt, so the debt of the company is at the end of 2010, debt of the company is 25,000 and equity is 35 plus 40 and plus 123 is a equity. So the debt equity ratio is 25,000 by 195,000. So the company is dependent on the equity. In other words, the business is financed by the shareholders' money more than the outsiders' long-term debts. So in a power business, or any business for that matter, if a set of transactions are given, you can convert that into financial statements and start understanding the effect of the financing decision on the business. In this example, the business is financed by, suppose we state financing decision, what percentage of the business is financed by equity? So equity is we have already seen that capital plus premium plus reserves is equity, is financing what percentage of the business? 85% of the business or 85% of the assets are financed by equity. 85% of the assets are financed by equity. So long-term debt is financing very small percentage of the business. The long-term funds finances 11%, and the balance is a current liability. The current liabilities are outstanding expenses here. So outstanding expenses are financing the balancing percent, that is around 3%. So that means the business is funded by equity to the extent of 86%. Long-term debt is financing 11% of the assets, long-term debt, and the current liability is financing the only 3% of the business. For a power business, the financing decision is important because the financing decision affects the price at which the power will be sold. In the later session, we'll understand the effect of financing decision on the tariff determination process. Thank you very much.